The time is 2 p.m. This is the Tuesday edition of Market View right here on Eswatini TV. My name is Nothelesi Tole, and as usual, we are your one-stop destination for everything business related. Today on the program, we'll turn our attention to a major development in the industrial sector. Government has announced that a 1.35 million malangeni will be made available to support MSMEs in the textile and apparel industry. This is funding through the newly revamped Production Incentive Scheme PIS 2.0 to provide grants and interest-free working capital loans to help struggling enterprises regain their competitive edge. We'll have the Eswatini National Industrial Development Corporation, ENIDC, to unpack how this fund will be rolled out, what it means for MSMEs, and how it can help position Eswatini as a strong player in the regional economy. But first, our business news. In our business news this afternoon, the Eswatini Energy Regulatory Authority has committed to delivering between 60% and 70% locally produced electricity by the year 2028. Speaking during the Nedbank Green Financing Seminar at the Trade Fair, Ndogozo Dlamini, Senior Engineering Manager at the authority, stated that the ultimate goal is for Eswatini to become an electricity exporter to other countries.
We are at the tail end and we are about to conclude the procurement of 75 megawatts of solar generation capacity spread across 4 developers. This is a procurement process, I think, that has taken us a few years. There's been much learning, but it's really private sector led. It's IPP, independent power producer procurements that are being conducted here through project finance. We expect the plants then from that procurement to come online, the initial few plants at the end of next year, towards the beginning of 2027. So that's the one program. And then we also have 2 other biomass programs to complement the solar because we need an energy mix that is diverse. We've got a 90 megawatt procurement from the core generators, your USL and ResCorp. These 2 projects are at different stages. The USL project is relatively advanced and it will also reach financial close towards the end of this year, and then the ResCorp one sometime before June next year. So there's quite a number of works that are ongoing. There's another one with EDF of France in a joint venture with Montigny here at Bunya to build possibly a 21.5 megawatt plant.
The managing director of Nedbank, Fikile Nkosi, says green financing should be made a priority.
The goals that we're tackling today is SDG number 7, affordable and clean energy. We are tackling SDG number 7, industry innovation and infrastructure. We are also tackling SDG number 13, climate action.
Meanwhile, the chief executive of the Eswatini Environment Authority, Gcina Dladla, emphasizes that financial institutions should broaden their base of green financing.
The domestic green finance has to be also leveraged with what is available at the global level because there's a huge opportunity as well at the global level. As I speak right now, I think in the next 5 years, we are anticipating something like 1 billion malangeni that is going to come into the country through development finance. So our banking colleagues, the finance sector, needs to then begin to leverage on that, whether it's through what we can leverage through carbon credits, what we can leverage, because the investments that we're doing, if we're able to probably generate 50% of our energy needs, for instance, we should then be able to say, how do we leverage that in the carbon credit space so that we can see more inflows of investments into this economy?
Additionally, according to the Eswatini Electricity Company, the maximum demand for electricity in the country ranges between 250 to 300 megawatts. Reporting, Nelson Dlangamandla, Vuminkosi Nzinisa, Manzini.
All right, and now we'll have a net break. Immediately after that, you are in for a treat because we'll be heading for our Enterprise Watch segment with the ENIDC. Stay tuned.
Eswatini TV has signed a code of conduct that is enforced by the Eswatini Communications Commission. We are committed to reporting news that is accurate, comment that is fair, and programming that does not amount to hate speech or the description of gratuitous violence or explicit sex. For any complaints of our programming, please contact us on 2411-9600 or email info@eswatinitv.co.za. You can also contact the Eswatini Communications Commission on 2406-7000 or write a letter to ECCOM on PO Box 7811 Mbabane. Email address is info@ecom.org.sz.
Back, you are still watching Market View. Onto this now, the Minister for Commerce, Industry and Trade, Honorable Mangoba Khumalo, launched the 1.35 million Malangeni Production Incentive Scheme 2.0, targeting the textile and clothing sector. During the launch at the trade fair, the minister announced that the scheme will be implemented under the Eswatini National Industrial Development Corporation, ENIDC, in partnership with the ministry. But questions are, how exactly will the scheme work? How do those in the textile sector qualify? To unpack this, we are joined by Menzi Bennett, who is a Research and Strategy Manager at ENIDC. A very good afternoon to you, and thank you so much for coming to the studio. The minister mentioned during the launch that the PIS 2.0 is aligned with the 2023 industrial policy and the Ngwe mandate. Can you unpack what this alignment looks like in practice, and what are some of the priorities of the fund?
Thank you so much, Notile, and the Eswatini TV for having us this afternoon. Yes, the minister has launched the PIS 2.0, which is the Production Incentive Scheme, which is led by the ENIDC, with support from the Ministry of Commerce, Industry and Trade. The program basically is meant to improve to improve overall competitiveness of the textile and clothing industry. Basically, we want to promote innovation and people-related interventions within the industry. You will understand that over the last years, the manufacturing value add for Eswatini has been declining, and as a result, this threatens the investments government has made along the lines of the textile and clothing sector. So it is important that we mention that this is a sector fund that is meant to drive industrialization, and it is meant to ensure that people who are employed within the textile and clothing industries, their jobs are secured, and there is sustainability. Furthermore, the scheme basically also targets clothing manufacturers, your garments manufacturers. It also targets cut and trim operators. So these are just sectors within the textile and clothing industry. So the expectation is that there is two components within the PIS 2.0. We have the upgrade grant facility, which is basically targeting both large and small large and small businesses within Eswatini, and then we have an interest free loan, which is also targeting the same. These are facilities that are meant to also increase the financial inclusion of SMEs, promote innovation and upgrading of textile and clothing system, and further strengthen the relationship between small and medium enterprises as well as those who are large in the form of subcontracting, because the expectation is that though the larger businesses must be able to subcontract those who are smaller. But then the question is, how do you subcontract someone who doesn't have the required assets to manufacture or meet the standard as set by the large textile companies? Hence why then government decided to say, let us also extend the grants to also benefit those who are smaller. The expectation is that we're going to provide the grant specifically to procure certain implements, certain assets that are used within the textile and clothing sector, Notsile.
Right. You mentioned that the PIS scheme offers 100% grants and interest-free working capital loans.
Yeah.
How exactly will these facilities be allocated, and what's the criteria that MSMEs will need to meet in order to qualify?
Yes, thank you so much, Notile. I think in terms of what each of the components of the PIS entails, in the grant facility for SMIs and MSMEs as well as large companies, there's just 3 categories in there. We are awarding approximately 1.35 million, as you rightly said, which will be categorized into 3 categories. We have micros, which are expected to share about 100,000, and 3 of them will be allocated within that category. We have SMIs, which are employing about 11 to 60 employees. They are supposed to share about 250,000, and then we have large companies, which are expected to share 1 million. And large companies, it's just companies that are employing more than 61 employees within their portfolio. And the expectation is that there will be certain application fees, because you will understand that the corporation will incur certain costs on that in terms of dispersing these funds. 100 Rand will be an application fee for those who are under micro. So those who are employing less than 10, about 10 or less people will pay that much. SMIs will pay about 500 Rands. And large companies are expected to pay about 1,000 Rand. Emalangeni to apply for these funds. And these funds, remember, they are just grants. And then ENIDC will undertake an evaluation to see exactly who befits awarding these grants, and then they will be awarded as such. So in each category, Notile, I'd like to emphasize that we will be awarding 3 top companies under micros, 3 top companies under SMIs, as well as 3 top companies under large companies. So it is important that we enlarge the pool and not necessarily focus on just one company, and ensure that at least a number of companies are benefiting from this exercise. Then with respect to the interest-free loan facility for working capital, there we'd like to make it clear that this is a loan that companies are expected to apply for. And the expectation is that we are trying to ensure that while you are waiting for your orders to be paid off, have some money to pay your salaries, have some money to, procure material if you have orders with your suppliers. And in that sense, it will bring the liquidity that is required within the industry. So the expectation is that for micros under the interest-free loan facility, you are expected to apply for up to 100,000, and this money is repaid within 3 months. As well as SMIs, they are also expected to apply for up to 250,000 interest-free capital. And then we also have large companies, in the sense that you have your orders with larger corporates. We understand they are working on a pressure. Sometimes they have to be paid a month later. So you can come to us and request that we provide you with a loan of up to 1 million Rands. And this is interest-free for the first 3 months. So the expectation is that after 3 months, you should have paid back the money with the corporation. But should you fail to do so, the expectation is that then the ENIDC will have to restructure the facility and then turn it into a long-term loan, of which that should be an agreement between us and the client on the terms and in terms of interest. We are going to have a 1% application fee under this facility, which is the interest-free loan facility. And then a company is also expected to benefit at least once a year, not silly.
Right.
Yes.
On the element of employment, Bennett, the textile and clothing sector is one of the largest employers of both women and youth in the country. Within the next 5 years of the rollout of the scheme, realistically, how many jobs do you think, as the ENIDC, actually, you can expect the PIS to help safeguard, not only safeguard, but also create, while also ensuring that, there's issues of payment. These jobs are decent, these jobs are sustainable, and there's fair remuneration.
Yes. Thank you so much, Notile, for noting that and raising that question. I think it's very imperative that these grants, especially the grants, it goes to the most deserving companies. There's companies who have employed and paid decent wages to their employees. Those companies must receive government support or qualify to receive government support. And companies that have employed environmentally sound principles and they are clear in terms of their responsibility in ensuring that the environment is safe, they are not retrenching people just because there's a noise or something, but they retrench them on the basis of credible information, So those are the companies that we believe if we disperse grants to, we will be able to sustain those jobs and also ensure that if they want to improve competitiveness, that means they will receive better orders in the medium term, and tantamountly that turns into a requirement that they meet certain standards, so they will have to employ more people and sustain more lives of Eswatini. Like you are saying, that these sector funds are basically in line with the current industrial policy that the Ministry of Commerce, Industry and Trade has actually promulgated earlier in 2023. So it is in line with that. We are promoting that the employment of women and youth and people living with disabilities. We encourage every enterprise that is out there to apply for these loans and access them, because government is really putting so much pressure to say, let us make funds available. If there is support that government can extend to ensure that there's sustainability, there's employment creation, and there's jobs for people, not just jobs, but decent ones. So if the valuation goes to the extent of evaluating whether the jobs are decent, are you implementing sound principles within the work environment for your staff, we are promoting that, and the grants will ensure that you comply at least for the next 5 years. Not silly.
Right. Partnerships are very key or important for the success of any initiative. If you may just highlight, the ENIDC has a partnership with the ITC in South Africa. Does this perhaps present any opportunities for our local MSMEs?
It does, Notile, a lot. We take pride in the relationship we have with the IDC in South Africa, and we believe in that it can assist because we have a relationship to co-fund certain projects on high priority sectors as deemed by the government of Eswatini. So the expectation is that businesses must not be afraid to actually we need to get rid of the box completely, because in that essence we can't be forced to think small just because our funding is limited. So the IDC comes in handy because we are in a relationship to co-finance projects with them. So the scaler doesn't matter. What is important is it an industrial project? Is it creating employment? Is it allowing people to participate fairly within the employment sector? So the expectation is that we are going to work with the IDC, co-fund projects. The MSMEs, if you want to grow and you require fund, submit your applications with us. We are going to appraise them and ensure that funding is made available and we attain financial inclusion as a country. Thank you.
Bennett, thank you very much for your time. That was Menzi Bennett, Research and Strategy Manager at ENIDC, unpacking the recently launched Production Incentive Scheme 2.0, particularly to benefit MSMEs in the manufacturing sector, in the textile and manufacturing sector. For now, we'll catch a break after that, our market analysis segment.
Eswatini TV has signed a code of conduct that is enforced by the Eswatini Communications Commission. We are committed to reporting news that is accurate, comment that is fair, and programming that does not amount to hate speech or the description of gratuitous violence or explicit sex. For any complaints of our programming, please contact us on 2411-9600 or email info@eswatinitv.co.za. You can also contact the Eswatini Communications Commission on 2406-7000 or write a letter to ECCOM on PO Box 7811 Mbabane. Email address is info@ecom.org.sz.
Welcome back to the program now for our market analysis segment. In-house economist Sanele Sibia joins me in the studio. A very good afternoon to you, Sibia. Thank you so much for coming through. A U.S. federal appeals court rules Trump's tariffs as rather illegal. How are you reading this? Will it, or is it already a market-moving catalyst, especially for U.S. markets, considering that tariffs are in effect?
Thank you, Notsilende. Good afternoon. So what we're seeing there in terms of those that ruling, and we do know that it's been appealed, right? So right now it's more of a muted type of what's it called? It's a muted type of judgment that it's there, but it's not changing anything. And in any case, the damage has been done, and doing this and unraveling everything that has already been done might actually just destabilize things that were already there, and agreements that were already reached, and very new, what's it called, new trade paths that have been carved. And when it says it is unconstitutional, I think it speaks more to the magnitude rather than speaking to whether Trump can impose tariffs or not. And we do know there's quite a number of ways in which he can do that. He can argue national security, and then once he does that, he's in the clear. So it just depends on the instrument and the tool that the White House decides to use. So I think markets are not reading too much into that. And unfortunately, it came during Labor Day, so we don't have much data to look into what is happening in the U.S. market itself. But when you look at the European market overall, we've seen a bit of a downturn, signaling today in today's trade. So. What we are reading into that is, yes, markets are looking into this as a judgment, but it's a rather muted judgment. But what is happening and what is moving markets within Europe today overall is the Eurozone inflation outlook and actually the budget deficit within the UK. So that's what we're seeing there happening. So in the UK, what we're seeing is those assets that are relatively, interest rate sensitive, like your what's it called, the real estate. We're seeing, a bit of a pullback on those because we've seen that, the Labour Party really has a bit of a mammoth of a mountain to climb in terms of convincing investors that they can deliver while at the same time coming up with those budget cuts. And we've seen one of the proposals that says to raise the to raise the money or to cover the deficit. What Labour needs to do is probably go up after lenders, the banks and all of those. So we've seen that actually pull back the markets in the UK, losing some 31.72 points in today's trade. And overall in the Eurozone, France remains relatively, it's just been penduluming between the red and the green today, largely due to those sentiments around the debt, the budget deficit in France, and also the issues to do with the Eurozone inflation, signaling that the ECB might likely keep interest rates relatively steady for the next coming weeks. And that happens in the background of unpacking the EU-US trade relations. So we don't know if markets are going to find another stimulus outside of the interest rates to somehow survive these turbulent times, if they do indeed remain turbulent. And then when you move into the Asian markets, again, Asia is quite eventful. We're seeing President Xi. I mean, right now we've seen President Kim Jong-un arriving in Beijing. I mean, we've not seen President Kim Jong-un in any other country for any conference in a very long time, but now he's in China. So we're looking to see what is going to come out of that. And in Japan overall, what we're seeing is, a bit of confidence coming back into the market. We're seeing domestic or Japanese investors coming back and to invest in the Tokyo Stock Exchange and thereby bolstering the Nikkei. And then in mainland China and also within the Hang Seng, what we're seeing is a bit of a correction. And also, when you're following up this conference of Asian Pacific leaders, and the story are coming up with the arrival of President Kim. So everyone is just waiting to see whether that is not going to antagonize the West even further and, cause for yet another fresh round of that trade war or any type of currency war between China and the US. So we're looking to see how that will play out. But when markets closed, the numbers really just show that there were a bit of losses within mainland and overall within the Hong Kong. And then in South Africa, we are at a point where we seem to have found a new equilibrium at the 100,000 mark. But overall market sentiments domestically within South Africa, we know that the markets are looking for growth areas, right? And we're seeing the effect of what was happening in Asia and China right now might actually come into affecting South Africa if the US wakes up today and after Labor Day and they decide to go after all BRICS countries, because that might be a bit antagonizing. So markets are somehow just taking a step back and watching to see what that President Xi's move is going to have an impact, whether it's going to have an impact on markets in Africa. And then when you look into the commodities, gold continues to rise because we're seeing that, there is a good chance that the Federal Reserve will cut interest rates. And then there is also the issue of uncertainty, the weakening dollar across the globe because of these geopolitical tensions, or the political tensions rather, that the Trump administration brings into the fray. And oil is ticking up to that 70 mark, and that's purely because we're seeing a bit of positive news with, growth prospects, showing that the economy might not be so bad after all. And then in terms of the currency, we're seeing, a bit of a mixed picture. When we compare the Lilangeni against major currencies, we've gained a bit of strength today against the US dollar, and we're seeing a bit of strength again against the euro, and also against the Japanese yen. So that's purely because, the metals are continuing to push forward and further, beyond the Johannesburg Stock Exchange. But the overall fear in terms of what the backlash might be due after that Eurasia summit actually weighs heavily on the Johannesburg Stock Exchange. Otherwise, the currency seems to be doing very well. Thank you.
Right, I saw positives in terms of commodities.
Yeah.
How sustainable is this, especially ahead of the anticipated rate cuts in September, or perhaps is it too early to read?
No, you would expect that. With that anticipation, gold is actually expected to hold ground while markets are assessing where the next winners are going to be in terms of commodity, in terms of of assets, in terms of those shares. Which shares are you going to buy while you're waiting to hold on to gold? And we're going to see a bit of a spike in the treasury yield curve, because we're going to see that movement from secure assets to those non-secure assets. And gold right now is becoming that transient point where, while people are looking where things are going to go, they'd rather keep their monies in gold. And in terms of overall demand, we're not seeing anything that might actually hamper overall growth. And then we do expect that Brent crude oil will stay in that 69. Basically might touch the 70, but on average should be 69, 68 going forward into September. And September is quite a tricky month because of that rate cut.
All right, Sanele, thank you very much for your insights. That was in-house economist Sanele Sibia filling us in on the day's trade. Otherwise, we've come to the end of today's edition of Market View. Until next time, do have yourself a lovely day.